Hello, investors. It's Don Vandenbord. It's Wednesday, 11/6. We're getting started here in a couple of minutes on today's Lunch and Learn. I am going to ask you to type in to the questions to make sure you can hear me okay. If you wouldn't mind typing in. There's somebody telling me the audio is good. Glad to hear it. We'll be getting started right on time here. And we'll got some good stuff for you today. We've been adding to this. I'm going to review everything. No, well, not review everything. I'm going to discuss everything that we've gone through in the prior 6 Lunch and Learns. This is number 7, and show you how to easily go back and get to them on our website. If you take a quick note of everything that we've discussed and the date, all you got to do is scroll back on our website. As I'm fond of saying, we never edit anything. We never take anything down. We are the most transparent registered investment advisor that you will come across. Between the videos that Tim and I do on 5 days a week, disclosing our buys, our sells, what's working, what's not working. That's right, a lot of things don't work. We're certainly not perfect. And as I'm also fond of saying, it's okay to be wrong, but it's not okay to stay wrong. And that's how we separate ourselves from the pie chart guys, because a pie chart will lose you half of your money in a severe downtrend, just like it did in 2000 to 2002 and 2007 to 2009. So I've got 12 o'clock straight up. Let's go ahead and get started. We'll go over the agenda first. Of course, this is for educational purposes only. We're not asking you to buy or sell anything. What we do here is present our process of how we go through the markets. We evaluate the strongest sectors and the strongest stocks or ETFs, and looking for low risk entry points, and then setting our stops and let the market take us out or go higher. If there's as close to anything that's a holy grail in investing, it's keeping your losses small and letting your winners run. Net, if your winners are twice as big as your losers and you bat 500, the math just tells you that you're going to make money in the market. So there are times we struggle. For example, right now we're in a not a bullish area for growth stocks. We're primarily a growth shop. We've been doing a lot of research in-house to determine how to best smooth the equity curve, and that's what really today's education is about, smoothing out volatility. Looking at what's working: large caps, small caps, growth, value, volatility, type of market, and what is working: breakouts, pullbacks, changing character stocks, liquidity requirements for entries that were taken, and a new portfolio that we're expanding in-house called Robotection 25, which is we've been running it for a while for a few clients, but I think that it's something that's going to get more popular because it's a combination of following the trend on a bigger time scale and taking advantage of some of the best growth stocks that are out there to juice the gains on that portfolio. And then we'll look at some charts of in-house holdings, and I'll take your questions and do charts on request. So let's talk next about what we've discussed. I know there are some new people joining us for the first time. As I said, this is the 7th in the series of Lunch and Learns that we've done, and I want to quickly go through what we've discussed, going all the way back in the prior 6, and then show you how to quickly get there on our website. So the first one, 8.7, I really focused on the broad set of 13 rules that I follow that's part of the process that I go through, and really they're my rules, but pretty much Dan, Tim, and I are always in sync with the way we want to do things. There's slight differences in our preferences, but for the most part, these 13 rules will keep you on the right path. 8.28, I talked about risk management, and that's really understanding your position size, understanding what your downside is. It's really so important. 9.11, this was 2 days after the huge change in character in the market, 9.9 and 9.10. You go back and you look at those dates on any value stock or any growth stock, and you can see a huge rotation. I don't know what triggered it. I don't know why it happened, but it did happen. And we really don't need a reason why. We just need to know what's going on. There was a huge growth or momentum switch into value. I talked about that. I also did something that's crucially important to success. That's a post-trade review. I went through 15 cases of trades that I've made this year and pointed out the good, the bad, and the ugly in there. And focus on the 21-day exponential moving average and the relative strength line on the charts, particularly, as you know, I use MarketSmith, and I'm a big believer in being above the 21-day exponential moving average in individual holdings, and that the relative strength line is pointing in the direction that I need to. And I also look at the 3-month relative strength, which is not plotted on the charts, but it's in all of the result sets that I run when I'm screening for stocks. 925, we talked about buy and sell rules and how we differ a little bit from the standard O'Neill methodology. Talked about psychology of what you own just because you own it. Are you going to be stuck favoring this stock just because you own it? That's a big problem. You have to treat things with an open mind. And then talked about Tim shows a lot of 3 ATR charts, and I love those. Something very similar on MarketSmith is the stochastics, really pointing out overbought or oversold. And it's a great double check to see that you don't want it, you're not getting into something when it's already overbought and due for a pullback, or you're not selling something right when it's starting to go oversold if it's not really breaking any sell rules. 10.9, I talked about the process I go through for sector rotation and the important questions that you need to ask about sector rotation. Just because something is in the top 20 groups doesn't mean that you can automatically buy it. For example, if it's been in the top 20 groups and the group relative strength is strong, but it's been in there for 6 months, good chance that some of the stocks in there are getting long in the tooth, and you really want to look for emerging sectors that are going from the last and second to last quintiles of the 197 groups and moving up into the middle or the second quintile. And then last lunch and learn, I talked about volatility-based entry sizing and earnings sizing. And all you need to do is go back. You can just go to revereasset.com, click on the Daily Market Insight link, and you scroll back to the dates that I showed on those topics if you're interested in seeing it. And everything's out here. All you need to do is scroll backwards. You see we've got 143 videos out here. Just scroll through, find the date. It'll say here, for example, October 23rd is the last lunch and learn replay that I did. And it's as simple as that. Today's number 7. Bookmark this site, and a lot of education out here. And like I said, every night after the close, Tim and I put a video out here, and then the three of us, Dan, Tim, and myself, this is the Brain Trust at Revere Asset, and we do podcasts on the weekend. And reach out to us anytime, Dan, Tim, or Don at revereasset.com. We're the most customer-centric registered investment advisor that you'll find. We're always going to give you an answer back. And if you want to talk to us, call 855-REAL-WEALTH, and we would be very glad to have a discussion about your particular situation and what we can offer you at Revere. We have 5 different portfolios, a little something for everybody, and then our latest one is a combination of Robotection and Growtection and stock and ETF, where some of the strongest from these portfolios will join some index holdings to try to smooth the overall equity curve. So there's an alert boot. I've always got alert set. I always usually max out the number that they allow you to have, and we'll take a look at that in a little bit, because that's one of the stocks on my watch list. So secondary indicators, this is also something I go through them every time I do a video. Tim shows a couple of them, but let's get into them, and let's start off with the Fear and Greed Index. This is something that I've found pretty impressive, And you need to pay attention when you're at the extremes, whether you're at extreme fear or extreme greed. Now, it's not automatically a buy or sell signal, as these are secondary indicators. I'm getting some comments that people can't see the screen. Can everybody see what's going on with what I'm showing here? Oh boy, I'm getting some people saying they're just seeing the opening screen. Okay, somehow the screen paused. Oh boy, okay. Hold on one second here. Let's go back. Okay, can everybody see? Okay, it's okay now. Great. Wonder how long it was like that. Okay. The Lunch and Learn review. Can you type in if you if you were able to see this while I went through it? Okay, no, great. Okay. I'm going to do a quick review. So I know you heard what I was saying, but the Lunch and Learn review. So here we are, 8.7.13 rules, 8.28 risk management, 9.11 growth to value, rotation, 9.25 buy and sell rules, 10.9 identifying sector rotation, 10.23 volatility based entry sizing and earnings sizing, and these can be found on our website, revereasset.com. Go to Daily Market Insight. Give me some feedback now if everything's working okay now. You should be able to see me scrolling through the different videos. Is that true? Okay, great. Thanks. Sorry about that. Not sure how the screen froze. Okay, so for example, there's all the dates on October 23rd. The last one that I did, Lunch and Learn replay, all you got to do is scroll back. Down the bottom here, there's 143 videos. Get to the date for the one that you want. I'll bring this up again. And here are the dates of the individual ones. And if you hit screen print on your computer right now, you'll be able to get a list of this. Or if you need me to send out the dates and what we went over afterwards, just shoot me an email and I'd be glad to point that out to you. Anyway, so fear and greed index. Pay attention when this is at extremes. Right now, we're at extreme greed. This isn't automatically a sell signal, and extreme fear isn't automatically a buy signal, as these are secondary indicators. We're going to take our cues from price and volume of the indexes and the stocks primarily. CBOE put call ratio. Tim has a very nice graph that he does of this every night, and focusing on the moving average that he talks about. I just look at the CBOE stats and see if we're over a 1.2 here. Usually that's we're getting close to a bottom. If we're under a 0.6 here, usually we're kind of putting in a short-term top. So definitely something to pay attention to. Next up, I use the McClellan Summation Index on the NASDAQ. This is a sign of fear and greed in the market also. As you can see, focusing on the RSI, whether it's overbought or oversold. For example, you can see for the last couple of weeks, coming off of oversold, you've had the wind at your back. Now we're in overbought territory, but you can stay in overbought territory for a couple of weeks. That's not automatically a sell signal when you get in, but what you want to keep an eye on is whether the RSI is rolling over and starting to trend lower. That's when you want to make sure that your stops are in place and you are on the right side of the market. And then finally, VIX Central. This is a visual representation of what's going on with the VIX term structure. You want to see this going from the lower left to the upper right, and you also want to see the dotted green line below the blue line. This is what's called contango. This is the normal bullish term structure. If your near months are higher than your further out months, or the dotted green line, which is the cash VIX, is higher than the opening month, then there is you want to pay attention to what's going on in the market. That means that there is fear present in the market that could drag the market lower. And then if you see that, you just look for extremes in fear going back to the fear and greed index or the put call ratio or what's going on with the NASI. So some good secondary indicators to follow there. So watch list. As you know, if you've been following me for a while, I keep this 21 over the 21-day exponential moving average list. I add to it periodically during the week. Some come off of it during the week. And let's go through this watch list very quickly to take a look at what's healthy. And by healthy, I mean over the 21. There'll be at least one that's coming off of it. So let's start off with Raytheon here. Looking good. I just don't want to repeat on every chart trending above the 21-day exponential moving average, but I am a strong believer in that being the dividing line from a short-term perspective of what is a healthy stock and what is not a healthy stock. Kroc, big gap up on their last earnings, then they snuck a secondary in there, which dilutes their shares. I don't think that they've priced it yet. Still holding above its breakout area. So what you want to do when a secondary comes out is look at where the secondary price is. When the stock starts trading above there, you can use the secondary price as a floor or an exit area, because that'll dictate to you how well the supply is being absorbed by institutions out there. Tesla, since their nice gap up on their last earnings report, this has been a good stock. Initially, there was a lot of short covering. Now you can see the volume drying up, coming down to average, and it's holding the ADMA. PHM, this is one that's probably going to come off the list. As you can see, Tim had a great sell on ITB. This is part of that group. A couple of weeks back, it went a little bit higher, but he reached his +3 ATR, and I double-checked the stochastics, and they were way overbought, and it was a good way to sell into strength. You can see some volume a couple days ago on this selling bar, and this came after they reported earnings. So sometimes earnings and a gap up can be bad. They can put the top in if you start pulling down. Now, I'm not saying that the run is over in Pulte. It did hit, an IBD rule, your breakout +20% is a sell area. If you sold there, you're not even worried about this pullback, and you're looking for your next entry. But heavy volume breaking below the 21. Now what frequently happens is if the 21 rolls over, it becomes resistance on any move by a stock to get back above it. And that's what I'm seeing right now on PHM. Doesn't mean it can't change tomorrow or Friday, but that's where we are right now. BLD, positive action reaction to earnings and continuing to trend higher. Mastech, big volume, 3 strong days up after some harsh selling coming into their earnings report. This is another one where once you reach pivot +20%, all you've done is sit around going sideways for about 6-7 weeks here before starting to give it up. So that pivot +20% is definitely an area to pay attention to. Teradyne had a gap up, but then failed on its most recent earnings report, but the failure volume has dried up and it's holding above the 21, and semiconductors are a leading sector right now, so this still looks good. ASML, same situation. It's trending higher. Another one that had a good reaction to earnings report, then moved down. Actually, no, this had a weak reaction to earnings, but it's held the 21, and sometimes a gap down puts in the bottom. And that's a good point. My next webinar, the focus is going to be gap rules. So join me in 2 weeks from today, and I'm going to talk about gap up and gap down rules to follow. Advanced Micro Devices, again, strong sector, good reaction to earnings, a little bit of a shakeout, held the 8. This is a holding in the Grotection portfolio right now. In fact, it got up to a 10% holding. Since it ran up here 15% in 4 days, I took half off, and now it's pulled back the last couple of days, looking for some volume to lower as it gets into the ADMA, which would be a good low-risk re-entry area for the other half position. Jabil, this has acted very well. As you can see, now it's hit pivot +20%. If you're in it, this would have been a good time to take profits. GPN, Global Payments. Payment stocks have been a little bit weak lately, but this pullback is on lower volume since its earnings gap up, and it's holding the 50 and the 21-day exponential moving average for now. YETI, last gap up, it was actually a gap down, and now you can see it's starting to break below the 21-day exponential moving average. Some big selling volume in there. They also had a secondary. I forgot about that. They announced that yesterday. So that's going to put a cap on it. Notice they also had a secondary here back in May, and it caused the stock, which was acting very strongly, to form a base. Always got to be wary of what's going on with your stocks. Vertex, this is also one of the largest positions in Grotection. Gap up here on an announcement that they got a drug approval for their cystic fibrosis drug, and it's just continuing to trend higher with volume lightening up today around the 80 MA, good low risk entry spot. ARWR, another strong biotech trending higher. Costco, this is also owned in Grotection, forming a nice cup and handle, volume below average when it's in the handle, fighting some resistance around this 300 area and just riding the 21 EMA. Have held this for a while, and this is sometimes you need to understand when you need to have patience with stocks as you see relative strength declining. This also corresponds to, I'm going to show very quickly, the stochastics going from overbought down to oversold. So this is when you see oversold at a holding at a very nice support area, great chance for a low risk entry. It should hold. If it doesn't hold, then maybe there's something else going on with the stock or the group or the market. Alibaba just had an earnings report, gapped up, but then had a shakeout, but now 3 days strong up on BABA with above average volume. JD, another Chinese internet content, had a big gap up a couple of days ago, consolidating that, but it does have earnings in 9 days. Boot, this is the one I just got my alert on. Somebody asked about this a couple of videos ago, and at the time I said it was acting fine, but I wanted to see what happened in earnings. So here's its earnings day. It had a big bar, shook out a bunch of people below the 50-day moving average, held the 50, climbed higher for 3 days, and now it's a pretty harsh pullback of 5% today. But notice the volume. If this said plus 200%, I'd be extremely concerned. Right now, this is really just a normal pullback to the 21-day exponential moving average and actually gives you a pretty good low risk entry sitting here on the 21. 5.9, this is something, there's 26 in the 25, in the 21 list. I've added 5 stocks this week. 5.9 is one I just added last night as it had a gap up on its earnings report. ATVI in a nice tight flat base, earnings tomorrow. RingCentral, this had a nice gap up on earnings, went right to the pivot plus 20%, stopped right there, pulled back, pretty harsh pullback, some volume in there. And now they just announced their earnings report, and it's holding the 21 since then. So when you have an event like earnings after the plus 20% hits, could give you a good shot to get a low risk reentry. DocuSign got stopped out of this when it broke below the 21-day exponential moving average here, and it's been a volatile one. A lot of eyes on this one in the William O'Neill and Investors Business Daily community, as it was one of the software stocks that really held up fine since it had this earnings gap up, but a little bit of volatility lately. And I like how volume tightened up right around here. Needs to hold the 21-day exponential moving average. Perhaps today was the shakeout. In fact, great sign here, volume 57% below average when it shook below the 21. So now what I would do is set a stop below today. It really should not violate that by more than 1%. TDOC, great reaction to earnings, consolidating sideways since then. Apple, just one of the strongest stocks in the market. Light, this is a new addition this week as it had this big gap up on earnings. Day 2 higher high. I love seeing this. This means Wall Street is really offsides on the story and it has a chance to go higher. I'm looking for a low risk entry in this. And XPO Logistics, I mentioned some transport stocks have been acting well during the change out of value, momentum into value. This is one of them. Just had earnings, pulled back, held to 21, and now working its way higher. So there's a 21 over 21 list. Let's go into the education section here and really talk about smoothing volatility in your portfolio. And one of the things you need to certainly be aware of is what's in favor. Is it large caps versus small caps and growth versus value? For a very long time, value was well underperforming growth. Anybody that's a listener to our videos knows that how long I have been talking about this. And really it started back here in February. This blue line is the relative strength line of the Russell 2000 ETF. And you can see it just keep trending lower and lower again, lower, 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 until about 3-4 weeks ago. But first, you had this big spike up here, and this coincides with, look at the date, this is the 9-9-9-10 move from value, from growth into value. There was also a big move into small caps at that point, which it, of course, then just turned around and gave back over the next couple of weeks, but now picking back up again, and we're at this 160 area, which has been a huge resistance. If you can get a break above this 160 area, I think the market will certainly be going higher, because small caps trending higher is a sign of risk on. So now let's talk about the momentum versus value. IVE is a value ETF. Basically you split the S&P 500 in half. Half of it is value, half of it is growth. And right here, look at the big spike up in the relative strength of value. And again, this was the 9-9-9-10 area. We had a gap up on some China news on 9-5. This was right after Labor Day. And then the next week, Friday was 9-6. Market was closed. Actually, no, the market was closed back down here. But the big move up started here, 9-9 and 9-10. So you see a big move in relative strength up there, IVE. Now let's look at IVW. You'll see the exact opposite. Big relative strength move down here, 9-9 down 0.72, 9-10 down 0.51. This is while IVE was doing just the opposite. I read somebody, a study on this, and said that this was a 6 sigma event, which means it's 6 times out of the ordinary of what you would see as far as how small caps were performing versus how large caps were performing. 9-9 small cap portion was up 0.9%, and then the next day up 0.6%, complete opposite of what's going on. And we certainly got hit hard in here, as we're in-house, as we're primarily a growth shop, as I mentioned. But I read some stuff about some growth investors that by the time this was over, they had lost 20, 25, 30% of their portfolios. Our losses were low single digits because of our position sizing and the way we keep to our stops. So while we're definitely underperforming, we're not getting crushed the way a lot of aggressive growth funds or other growth investors have been. Also want to show momentum, MTUM. This is another gauge, and you can see the big move down here on 9-9 and 9-10. Big move down here from a relative strength, and it's continued lower since then. You can see relative strength making lower lows while price is making higher highs. Momentum stocks, while they're going higher at much less versus the S&P 500. Now let's look at VLUE, and you'll see a complete difference in what's going on, and this is why relative strength is so important. You can see while it's making higher highs, the relative strength line is also confirming these higher highs, just opposite of what's going on in momentum versus value. Now let me go to a chart that I put together here. Where are they? This is a comparison of, come on now, show the charts. Again, sorry for the delay. Okay, here's a comparison of some research that I was doing last night. And what this is a list of the 11 sectors within the S&P 500 and their percentage of what they make up in the S&P 500. For example, tech is 22.4% of the S&P 500. Financials are 13% of the S&P 500. Now let's look at the growth component of the S&P 500. Tech is even bigger, 27% growth, and financials are only 5%. But look at IVE, the value portion of the S&P 500. Financials make up 21.5% of this index, and this is really where most of the outperformance has been. Somewhat in energy, somewhat in growth, somewhat in industrials, and in some cyclicals. But for the most part, if you've been overweight financials, you've done very well since the 99910 changing character in the market. And if you're underweight the way we are, you really just don't own financials, KBE. You know, it's just not an area of focus to us, but it will be going forward. Everything, we're always constantly improving our process, looking at other things that we need to focus on, and this is certainly one of them, breaking this up and seeing what's leader. I'm working on a research project breaking down and keeping a constant list of all of the leaders and how they're performing within the 197 industry groups. I went over the in one of the prior videos how to track what's happening and what's not, but I want to be ready to pounce right on these things as soon as they make the move from a lower ranked group into an upper group. So this is what really jumped out to me, is how the outperformance of financials has really been carrying the value portion of the market higher. Another thing I want to talk about is this comparison of what you see in the fear and greed index. Now I pointed out, so here's the fear and greed index as of last night. You'll see here when it gets above the 80 that's rare. This is overlaid with the S&P 500 right above it. Now let's take a look at why a high rating in the fear and greed index is not an automatic sell signal. So let's line up this area here. This was late 2017, and a big move off the bottom had just happened. Look at how the fear and greed index went from way at extreme fear, which is under 20, to above 80, which is extreme greed. This happened as the market was making this nice run up here, and it just broke out above this level. But if you sold at this area here, you were selling right here. The market then went on to work a little bit sideways, and notice how the market went on this late 2017 extremely strong run over the last month and a half, the last 6 weeks, while the fear and greed index never made a higher high. This is why you can't just say, oh, the fear and greed index is at 89, I got to get the heck out of the market. If you got the heck out of the market there, you gave up this entire big run up, and that's why these are secondary indicators. We follow them, we pay attention to them. But note that the fear and greed index does not always equate to a high or a low in the market. Sometimes, I mean, definitely at extreme points, you can see here, like here's another great example. It's below 20. This corresponds to right here. It's below 20, I better buy. Well, if you bought, you went lower from 2,500 all the way down to 2,300. That's another pretty extreme drop there, while the fear and greed index really didn't register that much of a change. So it's a good way to pay attention to where you are relative to it, but certainly this doesn't mean it's an automatic sell signal. I would certainly like to see a little bit of a pullback. As you can see, you did get a minor pullback in here into, you know, Tim talked in the video last night about pulling back into the mean, into the regressing into the 21-day exponential moving average. It always happens, and with some of the cash that we've got available, we're looking to deploy it if we get that pullback. But this is a good comparison of the fear and greed tool to what's going on with the overall market. So volatility-based entry sizing. Okay, let's take a look at that. And I've shown this before, but I'll show it again. What this is a calculation that I do when I'm calculating entries. And again, this is a way that I personally deviate from O'Neill. and the position sizes that they just take. Basically, I'm looking at my buy area, and then I look at the chart and calculate my stop area, and this tells me how far down my stop would be. But what I want to know is how big of a position size can I take for the volatility that I can deal with the individual stock. And really the key columns are right over here. What's the ATR? But that doesn't tell you nothing. You need to tell you anything, because stocks can be priced at anything. What you need to do is do a calculation to what is the ATR percentage. And you can see a stock like Beyond on an average daily basis, the ATR is 7.5%. If you took your normal position size on Beyond, a normal one-day volatility could have had you hitting your stop. So this is a situation where you really needed to shrink down your position size. My calculation said if I got in, I could only take a 3% position size to avoid getting shaken out on normal volatility. So find out what your ATR is, calculate, divide it by the stock price. This gives you a percentage. Anything that's in, let's talk about the indexes first of all. The QLD has, this is double, or the QQQ, the ATR is 1.38%. So if we're looking at growth stocks, anything that's just as volatile as the QQQ is going to be around 1.4. Those are hard to come by. It's usually at least double on the lowest ones. For example, you can see Restoration Hardware here has a 3.4% ATR, DocuSign a 3.7%, Floor & Decor a 3.2%. These are on the lower side. If it's in green, like for example DG, 2.2%, anything in green is highlighted as very attractive for an entry point. So these are ETFs again, and that's typically what you see with ETFs, but that they're lower. Apple 1.5%, Amazon 1.34%. And then I have things flagged. Something normal is in the threes. I start to get a little bit concerned, and I want to make sure I don't load up if it gets in the 4%, 4 to 5% range. And then certainly like Roku here is 8%. And I mentioned Beyond was 7.5%. You just can't take normal position sizes with these because you'll get shaken out on a normal pullback. With you look at that stock and you'll say, oh my gosh, it's down 7% on the day, but really that's its normal average true range for the day. It's not doing anything out of the ordinary. So I also calculate a 2 ATR size, and sometimes that's higher than the normal position size that I would take. So it tells me that I can size up a little bit. So that's volatility-based position sizing. Breakout, pullback, or change of character. I talked about that when I showed this up to whether or not when you want to participate, whether you're in an uptrend, buying breakouts or buying at support. If you're in a consolidation, breakouts are a losing proposition, and if you're in a downtrend, they certainly are. In a consolidation, buy at support or exit into resistance. In a downtrend, exit at resistance or buy breakdowns. Liquidity requirements. Somebody asked me to address this. When you're trying to determine what reasonable liquidity is for a stock, for example, let's bring up Lumentum here. This trades 1.2 million shares a day. What I'm looking for is a minimum of $20 million, and preferably the higher the better. I really prefer closer to 30 million. All you do is take the average daily volume and calculate it by the price, and this will tell you the average daily dollar volume of a stock that's traded. For example, if a stock only trades 400,000 shares a day, but it's a $500 stock, that's $20 million in daily dollar volume. I'm okay with that. Normally, I want something to be a minimum of 500,000 traded, and that would mean it would need to be a $40 stock. So really, we're taking 500,000, we're multiplying it by 40. That gives us 20 million in daily dollar volume. And simply, this is because just like yelling fire in a crowded movie theater, everybody headed for the exits at once, you're going to get shaken out. There's going to be a lack of bids on the stock. You're going to see a big price bar for that day, and the odds are that if you're not sized accordingly, you can really get shaken out of your stock. And that's why big liquid stocks are so much easier to hold, especially when they've got an ATR that's in the 1 to 2 percentage on a daily basis, ATR percent. And the Robotection 25 portfolio, again, we're always looking to smooth the equity curve for our clients, and the best acting portfolio that we have in-house this year is our Robotection 25 portfolio, which is basically we take the eight asset classes that our robo portfolios invest in, and those are domestic stocks, which is the VOO, that's really the S&P 500, or the VTI if you want to include a little bit of small caps. And international stocks, VXUS is the ticker symbol. Let me go through the charts of these very quickly. We'll do VTI first. You can see that's healthy, so our robo portfolio is allocated in it. And normally we're allocated in these unless we break below the 200-day moving average on a weekly basis. So we've been in, our robo portfolios have been invested in this at about a 40 to 50% percentage all throughout the year since January when we first broke out above after the big sell-off in the fourth quarter. VXUS, we've been in and out of this because, as you can see, this is broken several times below the 200-day moving average, which is the black line in here. So this is international stocks. BND, this is a broad bond index, which we're in as it's trending above the 200-day moving average. BNDX international stocks. Rolling over, but still above the 200-day, rolling over on the 50-day moving average, but still in the above the 200-day moving average. Emerging markets, another thing we've been in and out of as it's had several breaks below the 200-day moving average. XLE Energy, which we have not been in because, as you can see, it's been trending below the 200-day moving average, but you can see over here I've got alerts set. If we get back above the 200-day, this gives us an entry for that portion of the portfolio. Right now, that portion of the portfolio is in the equivalent of cash, which we can get about a 2.8% yield on by using an ETF called Pulse. This is an ultra-short bond fund with a very consistent NAV. It bottoms out after its monthly distributions around 50, goes up to between 50.15 and 50.19. And then pays out its distribution at the beginning of each month. So this is what we use for the cash portion of the portfolio. XLRE, real estate, trending above the 200-day moving average, so we've got a position in this. And gold we got in when it moved back above in this area here, as this is basing very nicely now. So 75% of the portfolio is scattered above those 8 asset classes, providing they're trending above their 200-day moving average. And then the other 25% is going to be allocated in 3 to 5 growth stocks, depending on how well we get a low-risk entry or a 5% position. And we're taking, between 4 and 8% position sizes, depending on how low-risk entry is. And there's stocks such as Vertex are in there right now. Costco is in there right now. This is forming a nice cup and handle base right here. But so really what we're looking to do is smoothing out the equity curve by riding the longer trend and adding some growth stocks in there for the spice portion of the portfolio when they're acting well. And as I said, this is our latest portfolio. It's a combination of really the stock and ETF and the Growtection portion of those portfolios, and then sticking that with the 8 broad asset classes. And this Robotection portfolio takes those 8, but it can also take a little bit bigger of a position size so that it's a little bit more allocated when we're strongly trending higher. But the main thing is it's going to be allocated in the asset classes at a minimum of a half size position as long as they're trending above the 200-day moving average. And again, that's our effort at smoothing out the portfolio, the equity curve for some of our clients. In-house holdings, let's take a look at a couple of those. I won't do all of them, but let's take a look at a couple of things. iPay is something that I recently bought. Now, I know the relative strength has been trending lower on this, but I bought it on this breakout above here. Looking at the charts of this holds like Visa, MasterCard, PayPal. PayPal had a nice earnings gap up, but it's since giving it back. But as long as this holds on to this 21-day exponential moving average, really primarily I want within a percent or two, I really want to see this get back above the 50-day moving average. But instead of buying any individual stocks, I went with the I got a good risk-reward entry on iPay, and if growth comes back into favor, these are the types of stocks that should participate. But I definitely don't like that the relative strength made a lower high while the price made a higher high, so the stop is very tight in there. I mentioned AMD also in there. I mentioned Vertex also being held in there, and Lulu got an upgrade today. That's a holding in there. You can see I'll give something one close below the 50-day moving average, but not much more than that. I've got a stop below yesterday's low on the Lulu position. This is about 2% loss in the Grotection portfolio right now. So 1247. Let's go to some Q&A and some charts on request. Let me go back and see what questions have been asked. Somebody's asking about Amazon. Let's take a look at that. Amazon had a big shakeout in its last earnings report. It had a gap down, but gap downs can be good from a standpoint where they can give you a reference point and a low to trade against. And in this case, let's take a look at a 60-minute chart on this. You can see the big gap down. We didn't undercut this prior low from a couple of weeks before that, so that was the first good sign. And then through the day, it clawed back most of the loss. So this tells me that Amazon, where it was trending lower, probably got most of the people that wanted. This has been underperforming for a while. In fact, since its last earnings report, note the relative strength, how it was declining. Broke below the 200-day moving average, couldn't get back above it leading into its earnings report, but finally clawed back above it and above the 21 and above the 50 in the past week. Now it needs to hold them. 1789 would have liked to see it hold the 1800 level. Giving it back a little bit. Let's blow this up a little bit. Okay, thanks. Little bit of a delay here on the feed. So here you can see it a little bit better here. Well, you could see it a little bit, but couldn't get back above the 200. But maybe pullback time. What you want to watch is, can it hold the 50 and the 200 and the 21-day exponential moving average right now, still above it? So 1775-ish. 1776 is the 50-day moving average. So keep an eye on that level for Amazon. Let's see. Is this a low risk moment in time to enter TLT? Let's take a look at TLT. It is consolidating in this nice flat base. I really don't want to see it break below yesterday's low. Then it's a couple more percent down to the 200-day moving average. The big breakout area for the TLT was back here on 731. Made a strong move up, and this coincided with the last move down, the last leg down in banks. Banks have been moving completely opposite of what's going on with TLT. So if TLT goes higher, I expect banks to pull back. TLT goes lower. Just look at what's happened for the last 4 days. You can see a pullback in KBE, bounced off the 21, then 3 strong up days. Now let's look at TLT. We had a move up and then 3 down days followed by a bounce. So TLT and banks are moving completely opposite. As you know, if TLT goes up, that means that interest rates are going down, which is kind of contrary to what you would expect with the banks. Supposedly banks are supposed to act well in a rising interest rate environment, but Who knows? The Fed is kind of says they're going to be neutral now. They'll see. They also said they didn't have any expectations for raising. They weren't anywhere near close to raising rates. So all we can do is don't look at the conventional wisdom. Look at what's actually going on the charts. Okay, what else do we want to see? LL. Let's take a look at LL. Lumber Liquidators. This is not a good bar today. It reported its earnings. Damn. This is a pretty volatile stock. For a while here, you see the declining 200-day moving average acting as resistance on this. It got back above it here at the beginning of September. I don't know what caused this. This isn't really something I track because its ratings aren't that strong. But whatever it was that made it go up, it gave it quickly back. It's consolidating here now, but it's under the 200-day moving average. You know, I'm fond of saying nothing good happens under the 200-day moving average. Reported miserable earnings today. Earnings down 70%. On sales 2% below. I mean, GDP is growing 3%. You don't want your sales falling 2%. Maybe this will put in the bottom today's earnings, but that is not a leader. Let's just sum it up and say that. Somebody asked me about Ally. Financials are acting well. This is, you know, acting relatively well. I do like that its PE is only 9, while its 2019 earnings are 26 and its earnings for next year are 13. Anytime you can get a price earnings to growth or a PEG ratio below 1, so here you've got 9 divided by 13, that's below 1. That's, from a valuation standpoint, pretty attractive. You can see they're certainly growing their earnings. It's got a low PE. This is as good as any financial, I would say. Building a base on base structure here. This was a stage 1 here. This is stage 2. This is really stage 2.1 base on base. It didn't undercut it. This looks fine. It should hold the 200-day moving average in the bottom of this structure, which is around the 30 area. Let's see what other requests we have. Regeneron, REGN. This is something that I put on my biotechs have been acting better, and Regeneron, you can see I've got the bracket set. Anytime I see a gap up, I set an alert for above the gap and an alert for below the gap. And this goes into a little bit about the gap rules that I'm going to talk about in the next Lunch and Learn. I wouldn't buy this until it got back above the 200-day moving average and stayed above the 200-day moving average. Right now, you can see this gapped up, but people sold into the gap. It's in the low. You definitely don't want to see it break below the low of yesterday. If it breaks above the 200-day moving average and yesterday's close, then it's a maybe buy. Wait for the 8 and the 21 to catch up to it. If it touches the 8 and the 21, they get above the 200-day moving average. That's certainly a low risk entry point. And then if it breaks back below it, if it's going to work, it should hold the low of this gap up day. Somebody asking about Mint and Pulse. That's a great question because, yeah, Mint is more liquid than Pulse, but it's a little bit more volatile on its NAV, and its expense ratio is slightly higher than Pulse, and its yield is 10 basis points below Pulse. So yeah, Mint is good. Pulse is a little bit better. If they were equal in liquidity, I would go with Pulse without a doubt. If liquidity is a concern, you can certainly buy Mint. PDD, Chinese stock, definitely one of the better acting Chinese stocks. Pinduoduo has earnings in 2 weeks, broke out on great volume, and then a second day follow through. First of all, it's a Chinese stock, so you've had the trade issues as a wind in your face. This is a nice long cup base on base. On its last earnings report, it gapped up and it didn't give it up. That's a big plus. Any pullback was within that gap up. That's another plus. Didn't get very far when it gapped out of that last base before it started forming the next base. But again, look at this black line up here. The market was correcting. And then we've had the trade winds that are possibly a factor in this. But this formed then a very nice cup base. I don't know what the catalyst was for this big gap up here, or this strong move on volume out of the base. It's now hit pivot plus 20%, but it hit it within 3 weeks. So if you're a strict O'Neill follower, you're supposed to hold this for 8 weeks. I don't ever do that. If it hits pivot plus 20% and I'm bought it at the pivot, I'm selling at least half, and I'm going to set a trailing stop and I'm going to keep an eye on it. There's no way I'm going to hold this through a 15% pullback during those 8 weeks. But you can see what happened today. It just got a little bit ahead of itself. It has earnings in 3 weeks. This is certainly a leader in the Chinese. It's Chinese and also in retail internet. Retail internet is a weak group. But that does, just because it's in a weak group, there are always catalysts and there are always leaders even within weak groups. So I don't know what the catalyst was for this big breakout here, but this certainly qualifies as a leader as far as I'm concerned. Their sales are growing very strongly. You can see 160% in the most recent quarter. They don't make money. That's something, but they are slated to make 57 cents a share in 2020. So that's a positive. And as I said, it's just hit pivot plus 20%, and now it's pulling back hard. This was all the way up to 45.25 today, and now it's at 43. So it's given up 5%. But anytime you see something trending like this above its 80 EMA, it's prone to harsh pullbacks like this, and this is certainly no different. Liquidity isn't an issue. It trades 7 million shares a day, so not too bad there. Google, and so Google, nice gap up. Google does this often. Here it had a gap up on its last earnings report and it sold off. Here it had another gap up on its last earnings report and it sold off again, but this time it held the 21-day exponential moving average. This is a leader in the FANG area. You can see they're increasing their sales from 7%, their revenue, their earnings from 7% in 2019 to 17% this year. I always like to see next year higher than this year from a growth perspective. I mean, Google's a winner. It's one of those where, but again, just because it's Google, I'm not going to hold this gap down and watch it fall from 1,300 down to 1,000. I just don't hold things through 25, 30% sell-off. So you take an entry. This is a base. You can see the base here. This is the handle of the base, although it's a little bit longer. I'd argue that this is really a flat base on top of this cup base. And it broke out of it here. It broke out of it on good volume. It pulled back on lower volume and it held the 21. So it's doing everything that I would want it to do. I would have no problem owning Google here. And we're coming up on the top of the hour, so this will probably be the last one with Baidu. This is a mess. I get it's a big name in the China space, but it's trending below the 200-day moving average. And to me, you just stay away from it. It has earnings, I believe, after the close today. After the close today, see what the reaction to earnings is. But this big gap down here 2 earnings reports ago, it tried to make a move up on its last earnings report, but this 50-day moving average provided resistance. So really, it's been battling back and forth around the 50-day moving average. But if you follow me for any period of time, if you're trending below the 200-day moving average, I'm not going to own you. And that is it. We are at 1 o'clock Eastern time, and that is going to wrap it. Let's see, we covered everything on the agenda. The next Lunch and Learn will be on 11/20, 2 weeks from today. The focus is going to be gap rules for the education section. Keep an eye out on our website, revereasset.com. As I said, go back on any of these prior topics that you think may have been interesting to you. Scroll back, listen to the Lunch and Learn. Send me in questions to address for the next Lunch and Learn, and let's get ready Any feedback, certainly I'd love to hear it, don@revereasset.com. And that's going to wrap it. Thank you very much, everybody. Have a great day. If you attended live, you will be sent a copy of the archive by the end of the day. Thanks.